Hello, welcome back everyone. This is another update and we've changed the format a bit. We're covering the world indices. So the S&P, the German DAX, the NIKKEI, the Chinese Xinhua market, the ASX200 and the NASDAQ. Before you go any further, make sure you hit that like and subscribe button to support the channel. In terms of the outlook as of today, June 27, S&P continues to climb on resilient consumer spending and tech strength, though valuations remain stretched and amid Fed rate cut uncertainty. NASDAQ led by AI and semiconductor momentum, bullish but vulnerable to profit taking after record highs. German DAX weighed by weak manufacturing data and slowing Chinese demand. ECB dovish stance provides support. NIKKEI strong corporate earnings and yen weakness fuels gains, but Bank of Japan's policy normalisation poses medium-term risk. The ASX200 supported by mining and banking sectors, though China-linked export headwinds persist. And the China Xinhua 500 remains sluggish as investor sentiment is dampened by property sector woes and lack of major stimulus. So starting off with the S&P, we'll look at the long-term trends first. And what we look at is the price and the CCI if they're above the moving averages. You can see there on the price chart, the price is well above the moving average, giving us a nice big bullish momentum. However, notice the CCI is broken below the moving average. And that was a response to this bearish divergence we drew. And that actually completed and it hit that 23-38% target range. And the way we draw that is, for those new to the channel, we draw a Fibonacci between that high and that significant low before that divergence started. And that's where that 23-38% Fibonacci range has been highlighted by that blue rectangle. Now, that looks like it's already hit and executed. That the wick of that month broke into that range and it's actually correcting now. So now the CCI is moving back into that moving average range. The other thing we look at is, so we look at divergence, we look at trend on the moving averages. The other thing we look at is fair value gaps. Now you'll notice down here, we had a few fair value gaps highlighted in those light blue cells, and they've all been penetrated with the subsequent wicks or candles after that. Even that one there was broken, and that candle there broke right through it. These ones down here, however, haven't been penetrated yet, so we're going to keep an eye on that. This could take years to play out, but at some point the price will very likely break down below that 4,500 point level and penetrate that range. If I zoom out, I don't want to go too far, we'll take it one step at a time, but basically we'll look out for any other fair value gaps that haven't been filled, and I can't see any there more recently, but again, this could take years to play out, so just be aware of that. So at the moment, the main thing we look at is momentum, and it's currently somewhat lightly bullish to neutral with the CCI still below the moving averages. I'd like to see the CCI and the price above the moving averages like it was back here during that period. On the weekly, likewise, if I zoom in a bit, you can see there we had a bearish divergence here. Currently we're bullish with the price and the CCI above the moving averages, so bullish at the moment, but notice it's hitting this resistance at 6147 and it's actually corrected after hitting that Fibonacci retrace. Now, we've got another fair value gap down here. Actually, we've got a couple of them, one in there we haven't identified, and one down there. So again, that sort of corresponds with the monthly chart as well. On the daily, you can see there very clearly we've got these fair value gaps nearer term in those last few days. So I'll mark them now. So just be aware that we might see a retrace back down there. This could take possibly hours up to even weeks to start pulling back. You can see there the CCI is starting to pull back a bit, and it may actually come back from where it is at the moment. Now, there's no divergence to talk of on the daily on that one. So at the moment, bullish momentum, but just be aware of that fair value gap. If you go to the intraday chart, let me go first off without the back test. You can see there at the moment, we've got a bearish divergence currently on the 1 hour time frame. On the left here, we've got the daily chart as a reference, so taking long trades only. And here on the right, we've got the 1 hour chart, and this is showing lower highs on the CCI versus the same period. From there, higher highs on the price. Now, it looks like the price may go higher possibly. So until it starts breaking down through that moving average range, we'll keep that as a continuation of an uptrend. But just be mindful, we've got this bearish divergence, and very likely it's going to come back down. So if it does pull back from where it is at the moment, and again, a bit premature to draw a target, we expect it to hit this 23-38% range. I won't mark it yet until we see this price pull back towards that moving average range, because again, this may rise more, and if it does, then we actually have to readjust the Fibonacci retrace. Now, if we go to the back test, what I've done, I've taken the back test starting back here when the price and the CCI were above the moving averages. You've got to be careful as well. You want to make sure both the moving average bands start curving up to be a bit more confident. You can see there that even though they broke above on the price at that point, and also the CCI, the price was still in a downtrend with those moving averages still declining. So you want to see ideally the moving averages start bending upwards like they were back here. So that's where we want to look at the back test at this point. And the back test here, you can see there the stop loss approach is about break even, hasn't really benefited much because you had a lot of swings, ups and downs, whereas the average down approach, if you let it run through the whole period, and I'm not suggesting you do that, it's generated about $30,700. Now, one thing to notice is at the very latest you should get out of the long trades during this period once you see the CCI on the daily break into that moving average range on the CCI, and that point there would have been around here. And you can see there on both the stop loss approach and the average down, the stop loss approach at that point generated just over $1,000, 1,082, and the average down generated 15,300. So you should have closed out your positions, even though you had a couple of on the average down, you had a position open there. You should have closed out. The other thing to notice as well is you look at the 1 hour chart. And why do you look at the 1 hour chart? If you're those regulars, you should know this by now. Is you look for any divergence. So during this period, in preparation for this downtrend here on that pullback, you saw a bearish divergence. So lower highs on the CCI versus higher highs on the price. What you do in this case, as soon as you see the price break below the moving average range, and the CCI is also dropping, so ideally the first exit should have been around this area here when that moving average range started declining. That's why it's always good to sort of zoom out a bit to get a 50,000 foot view. Don't zoom in too closely because that can sort of skew your view of it. So you can see there, you can still see it, but it's actually better to zoom out, is what I find. You can see there the CCI is dropping, the price is still rising, and then the moving average band starts dropping, and that's where you need to get out of it ideally at that point. And you wouldn't have had any positions open. Then wait for the CCI and the price starting to incline, and you would have got into a trade there, most likely. But notice again, that was a continuation of a bearish divergence until ultimately it hit this point here. And at the very latest, you should have got out somewhere around here. As we said, that also aligned with the daily breaking into that CCI range. And that's at the very latest, you should have got out somewhere in this period once you started seeing that on the hourly as well. So this is the NASDAQ, again looking at the long-term trends first. On the monthly, still above the moving averages, but again similar to the S&P, the CCI dropped below it, but it's finally into that moving average range, possibly about to break out in the next few days or weeks possibly. So looking quite good, and you can see there it's actually broken through that resistance up there we had at 22,240, so it looks like further upside. Again, we had a bearish divergence here on the monthly, and we drew a target range there, and that wick of that candle broke into that range and executed that divergence or completed that divergence, and then it finally broke out again. Now again, we've got another fair value gap here. You could possibly extend it down to this one here as well, although that one's been penetrated slightly into that range, but very likely we're going to see further decline. If it breaks down to this area, we'll very likely see the price break down to this area as well. Again, this could take years to play out, so I don't go placing short orders on that. We'll take it one step at a time. There's some more down here actually, and just be aware of those. So who knows when and if that'll happen. Again, there's no guarantee that they're going to be hit, but just be prepared for those if it does come to that. On the weekly, bullish momentum at the moment, the CCI and the price above the moving averages. That was we had a pretty strong retrace beyond 100% on that one when we had a bearish divergence. And again, similar to the monthly, we've got a couple of fair value gaps there that haven't been filled yet or struck. So again, we might see a pullback at some point in that area. On the daily, again, it's hitting through that resistance. I've got a second resistance up there at 22,494. And there's no divergence currently in play on the daily. We've got a fair value gap there which hasn't been hit. And that also aligns with this simple moving average of 200. So it might come back down to that area sometime in the near term on the daily. If we go to the 1 hour chart, again looking at the chart without the back test first, what we look at here is that the trend, and at the moment you'll see that the CCI is pretty much consolidating and declining. So it's a bearish momentum at the moment versus the price. So that's a bearish divergence. So we draw that trend line down there, and at the same period we take it to that high there. Again, similar to the S&P, I won't draw targets yet, but if it was to pull back from where it is now, we take it from that high down to that low, and that'll be your 23-38% target range. So again, this could keep rising. So once it does, if it does continue to rise, we're going to recalibrate that Fibonacci retrace to get the new measurement. Now, similar to the S&P, the NASDAQ has started back here going bullish from this point when both the price and the CCI are above the moving averages. And that's where the back tests here are showing up for the stop loss approach and the average down. The stop loss approach here has performed better than the S&P. Had you let it run through the whole period, and I'm not suggesting you do that, that's generated 338, and the average down has generated 11,772. And again, similar to the S&P, you had this pullback in that CCI during that period, and that's where you would have got out with stop your trading going long during that period. Again, notice in that same period, if I zoom in here for a moment, that's the same area, similar to the S&P, where you saw a bearish divergence, lower highs on the CCI versus higher highs on the price. You probably would have got out a couple of times there, maybe once you would have got out there. And this is where you probably got to be careful of re-entering into the trade. So once you're seeing the CCI decline and the price keep going up, don't get greedy. Even if you got out at that point, you should have been happy with that little profit at that point there. Wait for the CCI to start realigning and moving in line with the price again. So you can see there, as long as the price keeps rising and the CCI keeps dropping, that's a divergence, until such time you start seeing the CCI and the price moving in alignment. That's where you started seeing this movement, this pattern. Even if you go across, you can see there the same pattern occurs. So the CCI now starts moving in line with the price, and that's where you start taking trades going long whenever it breaks above the moving averages. So for the German DAX, on the monthly, first off, very strong bullish run at the moment, above the moving averages on the price. Likewise on the CCI, so nice big bull run on the monthly. So that's the first thing we look at, is the trend above the moving averages. The next thing we look at is for any divergence, and currently there's no divergence showing up on the monthly. And lastly, we'll look at any fair value gaps. So you can see here, I've highlighted these fair value gaps down here. These ones here have been penetrated with the wick of that candle. This one down here has been penetrated with the wick of that candle, and these ones down here I've identified have not been penetrated yet. This one here has, with those candles. So just be aware of that. We might see, again, this could take years to play out. Doesn't mean it's going to happen overnight. So just be aware of those. We don't trade that. It's just more of an awareness. On the weekly, we've got a bearish divergence. But first off, on the trend above the moving average of the price, this one's neutral. It's in the moving average range on the CCI on the weekly. So somewhat neutral positioning at the moment on the weekly. I've got a few things highlighted here. This, first of all, zooming out, we've got a bearish divergence versus higher highs on the price, and I've drawn a target range, and that was that 23-38%, that blue rectangle. Hasn't quite hit it yet, so it looks like it may be coming down towards that range, even though it's the price this week so far is nice. It's a bull candle, but we might see further declines into that range in the coming days or even weeks. This red area I've highlighted is the fair value gap. You can see that area there has already been penetrated with the wicks and candles there. These ones down here haven't been penetrated yet, and that coincides with this bearish divergence target. So just be aware of that. And zooming out, we've got another range down here which also correlates with this monthly fair value gap. So just be aware of that. We might see a bit of a weakening at the moment on the German DAX on the weekly. On the daily, hit that resistance up there at between 24,492 and 24,355, and it's bounced down. Now, we did have that's almost like a triple top on the CCI, and I consider that a bearish divergence versus higher highs on the price. You can see that's almost like a triple or quadruple top, and then the CCI finally fell off. So that's a bearish divergence. And I drew a target range there, but I have to readjust that possibly since our last video. So let me just draw a Fibonacci. That's what I mean by readjusting. So it's a very slight readjustment from where it was previously. So that needs to go there. And let's see if it's hit that candle, the low of that candle. The low is 23,023, and that 23% is 23,150. So it's actually broken below that 23%. And that's all you need for these divergence to be hit. And it's actually hit that, and now it's adjusting and moving back to the upside. So again, just be aware of that. That's how you measure that 38% minimum range. More than 90% of the time it hits that range. But as well, I notice on the daily, we've got these fair value gaps also identified. So just be aware of that. This one here, as I said, it's been hit already, about 25% of it, but very likely we're going to get further downside possibly. But at the moment, the CCI is bullish and the price looks like it's going to break above that possibly next week's trading. Now, if we go to the 1 hour chart, we look for any micro moves. So even though it's showing somewhat neutral to bullish movement, you can see on the 1 hour chart, I did draw this bullish divergence on our last video. That's identified by this dotted line. And that was the target range there, assuming it pulled back from there. Now, since then, that's why we've got to look at these moving averages. Since then, the price has dropped further. So I'm going to extend that to that point and drop that to that level. That's still a bullish divergence. So what do we do now is we readjust that blue area, that target of 23.38%. It'll be a very minor adjustment, but it needs to be adjusted nonetheless. And let's do this. Let's drop that to there. So the 23.38% goes there. And you can see there it's actually already hit that 23.38% range. Sometimes they go right through. This one pulled back and then it corrected and it went higher. So it looks like it's going to continue higher possibly. But notice the trend is broken into that moving average range, giving us a somewhat neutral positioning, even though the price is above the moving averages. So what I'm saying basically at the moment, wait for the daily to break above on the price. The CCI is already bullish. As soon as you see that happening, then you can start taking long trades. So just stand to the side yet. Don't take any trades, long or short, until we see the daily, if you're trading on the hourly, that is. So wait for the daily to break bullish to take any long trades on the hourly. In terms of the back testing, what I've got here, first off, I'm going to go back to this period similar to the S&P and the NASDAQ to around the 24th of April, which is back here on the daily, when the price and the CCI were above the moving averages. And that's where you would have taken some long trades. Now, again, similar to the other charts, whenever you see the daily break into that moving average range at that point, and you can, if I leave the cursor there, you can see there on the right side, you would have got out of the trade somewhere around here on a stop loss approach. It's at 23.98 on stop loss, and on the average down was about 13.980. But having said that, you'll notice here we had a bearish divergence early on, and you probably should have carefully traded that. And then we had a few more bearish divergence here. One there, so you should have got out of the trade at that point there, if you're still in a trade there. Another one here, this one is a bit longer duration. And then finally you would have got out once you start seeing the CCI drop and the price also drop below the moving averages and the moving average band pulling back. And that's why you would have avoided this drawdown. So just be very careful and always follow the discipline rules. Now that's the bullish trading or back test. I've also got the testing for the back testing for the bearish momentum. So that's, you would have entered going short. Once you start seeing the price break below the moving average range on around 11th of June, and the CCI was below the moving average band as well. That's where you would have taken the short positions back here. And that's indicated by this point. Now again, notice here, we had a break above on the hourly, and the CCI was rising. That's where you probably should have closed out your first positions. And at that point, the stop loss approach was in a negative by about $700-800, and the average down was up about $2,500. So whenever you see the price and the CCI moving against you, close out your positions on the hourly. Now in this case, the price rose a bit, then started to drop again, and so did the CCI. So you possibly could have got into some short trades there again. But again, always follow the daily trend. And so you would have got in short positions there again, and until you started seeing the price and the CCI moving against you again. So you would have got out of the trade at that point. So again, the stop loss approach was in a negative. Again, this is showing you had you stayed in the whole period of trading. The average down approach was generating about 8,100. So again, during that period, that bullish divergence versus lower lows on the price, that was back at that point. If I leave the cursor there, that was the start of this pullback into that moving average range on the daily. So that's where you should have got out of the short trades. And at the moment, again, as I said, wait for this to break above on the daily, on the price, to start taking long trades in accordance with the daily trend, but make sure that the hourly is also bullish in your favor. Currently, the CCI is showing a somewhat neutral to bearish momentum. So the Japanese Nikkei on the monthly, the This month it's broken above the moving average band on the price, and also it's broken into that moving average band on the CCI, giving us a somewhat neutral positioning. Bullish on the price, but neutral on the CCI, so just be cautious. Got this resistance up here at 42,498, so it possibly may rise a bit further. That's why we look at the lower time frames as well. But notice back here we had a bearish divergence. The CCI was dropping off, this one, and then we had it versus higher highs on the price at that point. Then it dropped off, and it finally, a couple of months ago, it dropped quite strongly there again. Notice that was very similar to that wick, dropping back towards that support level at 33.45. Now also notice we've got these fair value gaps here have been penetrated by these wicks, so they're all no longer relevant, I should say. But these ones down here I've marked in red haven't been penetrated. This one's been penetrated mostly. It has got a bit to go, but the reason I've marked that is because we've got this one down here that hasn't been touched. So if it does fall through that point, it's going to very likely come down to this area. And again, that closely aligns with this moving average 200 down here. So just be not sure what's happening or what's going to happen in the near term, but again, this could take years to play out. Is there a war? Is there some sort of economic collapse? Who knows? But just be aware of that. On the weekly, again, we had another, in terms of momentum, we've got the price above the moving averages, and so is the CCI, so bullish on the weekly. There's no divergence at the moment. There was a divergence back here, but that's already played out, hit our target range. And now more closely, we've got these two fair value gaps to be aware of on the weekly. Again, we take it one step at a time. We take it from the smaller time frame up to the largest. So if it goes through this area, then we start looking at the next levels. On the daily, you can see that it's broken through that resistance we had previously drawn, 38,760. There's no resistance at the moment. Both the price and the CCI are bullish above the moving averages, and there's no divergence that I can see. So that's moving nicely at the moment for the Nikkei. If we go to the intraday charts, first off on the hourly, taking long trades only. Again, the first thing we look at is a trend. You can see there the price is well above the moving averages, bullish momentum, but notice the CCI is weakening. Now the second thing we look at is divergence. You can see there from those peaks on the CCI, lower highs versus the same period, higher highs on the price. Again, it's a bit too early to draw the Fibonacci retrace because the price could possibly keep rising, but notice the CCI is pulling back, and so far at the current hour as we speak, that's a bearish candle. So we might see a bit of a pullback. And notice all these blue areas. These are all fair value gaps, right down to this area here. In fact, down to this point. So I'm going to mark all those. I'll mark these ones initially. Just mark them separately. You could probably mark those as one. These ones back here have been penetrated with those candles, but this one down here has not yet. And finally, in terms of that period, actually I'll go back to this point here. You've got those ones down there as well. So it's quite a few areas down here on the hourly to be aware of. So we might see a bit of a pullback, and that also aligns with the daily, as I said. This is showing fair value gap there as well. So if it breaks through there, then we look at the next level. That's already been penetrated. The next level will be possibly down somewhere here on the daily. But we take it one step at a time on a smaller time frame. So these are all fair value gaps, haven't been filled yet. Now, in terms of back testing, we're going to look at long positions only because predominantly the price and the CCI going bullish momentum. You don't take short trades. And that starts back here around about the 24th of April when the price broke above the moving averages, and so did the CCI. So you can see there on the stop loss approach, had you let it run through the whole period, stop loss did okay, 9,300, and the average down did well as well, 89,300. But again, notice these drawdowns. And what do you look for when you look for any potential reversal? Well, obviously we look at divergence on the smaller time frame on the hourly. If you're trading the hourly, you look for that divergence. We had higher highs on the price versus lower highs on the CCI. And this first one, you would have avoided that drawdown because you would have noticed this first bearish divergence. Then the price seemed to adjust. But if you had drawn another divergence extension from there, that was still almost a double top on the CCI. Then back here, we had another bearish divergence. Now remember what I said some time ago in another video. I've said it a few times actually. These very narrow ranges of divergence have a lot stronger pullback effect. So you can see here lower highs on the CCI versus higher highs on the price, and that pulled back quite strongly and hit our 23-38% target range. And had you got out of that long position, you would have avoided that drawdown during that period. So, and then it's corrected itself, it started moving in line again. Then we had another bearish divergence here, lower highs there, higher highs there, and avoided those respective. We had another little one there, you would have avoided those drawdowns. So always pay attention to the divergence. So what I'm basically saying at the moment, if you're going long during this period and you're making nice little profits, take heed. There's a bearish divergence and we may see a pullback slightly in the coming hours. So at the moment, since I just finished speaking, you can see there that candle's gone from red to green, so it's actually pulling higher. So wait for it to start pulling back towards that moving average range to potentially close out your positions if you're holding long positions now. So this is the ASX200 for my Aussie friends out there. On the monthly, first off, we've got we look at the trends well above the moving average band on the monthly on the price, and it's also a fresh breakout to the upside on the CCI. So bullish momentum at the moment on the monthly. But notice we've got this very long term. It started back in 2021, a very long term bearish divergence. So, and that's actually hit its target range. We drew that 23-38% range, and that wick of that candle a couple of months ago hit that range. So that's the next thing we look at. And lastly, we look at also any fair value gaps. You can see there's one, actually that's been hit, so I'm not going to mark that. That's already been hit by that candle. That one there has been hit by those candles, and note that there has been at least 50% hit with those candles there. There's one down there, a very narrow one, so just we'll keep that there. That sort of corresponds with some of the other markets we're looking at. So you may see the price break down to that mid 5,500 level. But currently it's bullish momentum on the monthly. On the weekly, currently bullish on the price, bullish on the CCI, but notice we've got a bearish divergence versus almost a slightly higher highs on the price. And we haven't drawn a target range for that yet. Looks like it's already pulling back, but let's just, yeah, well, if we're going to draw it, we'll draw it back to that range there. And that'll be the 23 down to there, 38% range. If we were to draw a target range for that, that's where we expect it to go if it continues down on a downward trajectory. But currently this week it's been bullish, so looking positive at the moment. But again, notice the CCI is pulling back, so we might see that bearish divergence start playing out. Also, we had this fair value gap down here, which corresponds with this bearish divergence as well. So that looks quite ominous. On the daily, we've hit this resistance up here at 86.43, and first off on the trends above the moving average band. The CCI is in that moving average band, gives us a somewhat neutral positioning. There's a bit of a shooting star there possibly on the currently on the daily, so I might see further downside there. These fair value gaps, they're all being hit by this candle. This one's been hit by that candle or that wick. They've all been hit. This one down here, as I said, hasn't been hit. Now I'm going to mark that, move it to there. So that hasn't been hit yet. So it looks like we may see a price retrace back down on the daily, at least to that level there. On the intraday chart, the 1 hour chart, so far this today, as of trading, bearish day today for the ASX. We don't take long or short trades because the daily is giving us a mixed signal. It's currently neutral on the CCI and somewhat it's bullish on the price chart, but doesn't look too healthy at the moment, with the hourly breaking quite strongly to the downside. But again, notice there, what do you see? We've got nice big fair value gaps haven't been touched yet, so we're going to see a retrace at some point higher in the coming hours or days. Again, this one down here is slightly penetrated, but not fully, so we might see a price breakdown towards that moving average. And down here, you've got that hourly period back here, which hasn't been touched yet. So if we go to the back test, going to the long positions predominantly, you would have started going long based on the CCI above the moving averages, and so is the price, and that's where these begin around about the 24th of April, similar to the S&P and the other markets. On the stop loss approach, hasn't been doing too badly, about $500 return versus the average down 11,800. Again, paying attention to bearish divergence. I haven't marked them all, but just eyeballing it there from a distance. You can see there we had bullish move there versus, oops, let me just do that again, versus a bearish move there. Then you started seeing another somewhat bearish move there. So quite volatile here. That's bullish, that's bullish. That's bearish. So you don't have to zoom in too far. You can do it from a distance, and I like to do it from this sort of distance. It gives you a clearer view of the price movement and the CCI movement, and it's a lot easier to identify. So that's lower high. It's bearish, bearish, bullish, bullish, so bearish there, bullish there. Okay, and then you get out of any long trades during that decline. Once you start seeing the moving average band turning down and the CCI moving average turning down, you get out of the trades. So you would have got out, in and out a few trades. In other words, you would have avoided some of these drawdowns, especially this one. Once you start seeing the CCI and the price dropping off, you would not have been in that trade. But again, I'm just showing you here running through the whole period, and I'm not suggesting you do that, what it returns. But had you avoided that, you would have avoided the averaging down and the drawdown. And finally, the China Xinhua A50 cash on the monthly. Bullish momentum on the price has been pretty much consolidated for the last few months. And what have we got there? The CCI is a fresh breakout to the upside. So bullish momentum at the moment, very slight bullish momentum. On the weekly, very consolidated period back there with a lot of volatility above and below the moving averages on both the price and the CCI. But similar, we've got bullish movement at the moment. Now we had back here on the monthly, we had a fair value gap that was hit by this wick of that candle. So most of that's been covered, and so is that period back there with the candle movement there. On the weekly, that mostly 75% of that's been filled, and we might see further declines possibly on the weekly on that one. On the daily, bullish momentum at the moment on the CCI and the price, but notice we've got a big strong bearish candles currently on the daily, and moving further to the downside. And I've marked these fair value gaps here, which haven't been touched yet, and looks like it's going to touch that in the coming hours, if not days, possibly. So CCI is weakening. If we go to the intraday chart, look at it more closely, you would have taken long periods back here when the daily broke higher above the moving averages, and that would have been a nice little bull run there. But again, paying attention to the divergence, had a bearish divergence there. That would have been your first indication after getting that peak. In fact, that would have been actually no, that was moving in line with the price at that point, so not a bearish divergence until that peak there, and it fell off, and that was your first sign of a bearish movement. And since then, the price has collapsed, and I've marked already this fair value gap that's been penetrated by those candles, and we've got another one down there which hasn't been filled yet, so very likely going to get down to that level in the coming hours, possibly. Now, on the back test, there's a couple of things I want to show you here. Looking at the daily, you would have taken long positions when the price and the CCI broke above the moving averages from this period. So again, you would have avoided that based on the hourly, because the CCI and the price were declining. So your first entries would have been somewhere in that period there. And again, highlighting divergence just from a 50,000 foot view, you would have been following the daily trend as well. So at the very latest, you would have got out on that one on the daily. But again, looking at the hourly, those highs, there's bullish movement there. Until that point there, you got a declining peaks versus the same period to there, in fact to there, higher highs on the price. So you keep following it until you start seeing it. So you would have got out during that little drop on the price if you're going long during that period, paying very close attention to the bearish divergence. So that's giving you an indication it's going to go short, and it did, and you would have got out of the trade there. Until at that point, you would have gone long again there, and then the price started dropping off again. You would have got out again there. This period, you would have gone long again at that point until you started seeing this bearish divergence. In fact, that wasn't a bearish divergence because those peaks are lower, and so are those peaks, and you would have got out of the trade at that point, and so on. Now, at this point here, we've got a bullish divergence. So that would have been your first sign of a potential reversal, and that period there coincides with this period back here. So you can see there, when that daily starts pulling back, you notice it first on the hourly, you had a bullish divergence. So you would have started going long potentially there once you start seeing that move towards the moving average on the daily. You could have got in there, and then you start looking for any divergence. I'm just eyeballing it now. Those peaks and troughs are moving in alignment. There's a little bearish divergence there versus higher highs on the price, and it fell off. Now, that's going long. Now, again, notice how volatile it moves going sideways with that, and you would have got caught. So you would have avoided going long during that period, as I said. So you would have started going short during this period, and that would have been in alignment with this period back here on the daily when it drops below the price and the CCI moving average. And that's where you've got the short positioning back there. Again, noticing the bullish divergence. That's where you would have been careful and got out of the trade at that point. So that would have been your first profit at that point. It would have been a break even on the stop loss approach, but a small profit on the average down. So going short there, avoid going long, avoid going short during that period. Obviously, this is the short back test until such time. Again, always following the daily, going short until such time as that point there. Again, following any bullish and bearish divergence. At the moment, bullish movement on the daily, and it's going short on the hourly. So avoid going long or short until we see the hourly at least break to the long side. But at the moment, it looks like it's going to drop further with the way it's moving. So let me know if you prefer this consolidated approach to reviewing the charts, or should I stick to the reviewing individual instruments? If you're new to trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. If you enjoy the content, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.